Hello everyone, welcome to today's short video just walking you through what you own as you move into retirement. One of the biggest problems that I see, whether it's a couple, whether it's an individual have, as you get closer to retirement is you don't actually know what you own and you don't know how to track it. So I'm just going to simply walk through what this looks like. Now this is just a very standard demo account. This isn't Fidelity, this isn't Schwab, this definitely isn't Robinhood. Robinhood's way more fancy and bright in colors than this is. But I'm just going to walk you through the different types of accounts that you might have, how you should be thinking about them, ways that you should be looking at your performance and knowing what that means for you, as well as what your gains and losses are from a tax standpoint as you get into retirement, okay? So I promise I will be jargon-free, and I promise I won't dive too far into the details so much that it bores the daylights out of you. But with that in mind, let's jump right into it. So this is an entirely fictional client. As you can see, this dapper gentleman up here to the left does not actually have $2.5 million. But if he did, these are the accounts we're going to say that he has, okay? So you're most familiar with a savings account. For this instance, I'm saying this is at Chase Bank. But this is just your savings account that you currently have at your bank. A lot of times you're probably not making any interest on this, maybe 0.01%. So go ahead and buy yourself a nice spaceship with that. But ultimately, a savings account is there just for your emergencies, right? A lot of times we say if someone is in retirement, they might have 1 to 2 years worth of their needs in this savings account. Ideally, it would be in a high yield savings account, netting them some interest to keep up with inflation. But you already know what a savings account is, so I don't want to kind of drag there too long. An individual account, that is just a brokerage account, if you've heard of this before. I have another video on this, but all a brokerage account is a non-retirement account. Okay, it doesn't have any income limits. It doesn't have any age requirements. You can contribute as much as you'd like to after tax every single year, and you're only taxed on the profit that you have in that account. So anytime you hear someone talk about a brokerage account or a joint account or an individual account or even this trust account down here, okay, generally they're always just talking about this account. It goes by way too many names and it confuses people, but you just need to know that you're putting in after-tax money, meaning you don't get a present-day deduction on the money that you're putting into it, and two, when you pull that money out, it's only going to be taxed on the profit portion, okay? Now, there is some nuance to that, which I'll get into here in a moment, but let's keep going. A Roth IRA, as you know, is similar to a regular or traditional IRA, except with a Roth IRA, you're putting in after-tax money, similar to the individual account. But this one has a few more rules around it. Again, I have other videos on this, but a Roth IRA just means you put in after-tax money, it grows tax-free, and then assuming that you're older than 59 and a half and assuming that you've had the account open for 5 years, all of the growth and everything that you pull out of that account is not going to be added to your income, and it's going to come out tax-free. Okay, so two huge potential benefits there. And then finally, the traditional IRAs. This is similar, okay, to a Roth IRA, except for instead of putting after-tax money in, we're putting in pre-tax money. And generally, you're going to take a deduction on your income for the year that you put this in. So let's say that you make $100,000, you put $7,000 of this money into a traditional IRA. Well, then at the end of the year, or excuse me, at the end of when it's time to file your taxes in April, you can take a $7,000 deduction based off of what you put into your traditional IRA. So that's the three biggest differences between these three accounts. They are the most common, and generally, I would say it's helpful to have all three of them if you're looking for the maximum flexibility as you move into retirement. Okay, so now let's move into the actual portfolio, and I know there's a lot on the screen here, and I'll break it down rather quickly. Again, this is all fictional, so don't take too much from it. But really what we're talking about here on the left side, this would generally be where you would see how much you have gained and lost for the year, how many additions you've made. But most of the things I want to focus on here are these three squares. So the first is allocation. And this is not allocation in terms of are you invested 60% in stocks, 40% in bonds. This is how much of your money is allocated between your different types of accounts, right? So the accounts that I just walked through, what portion of that is in each of those. And this is important because this is ultimately going to decide how it's taxed. because if you combine the 50% with about 14, that means 64% of my money is in an account that's going to be taxed to me in retirement. That's something I want to start thinking about if I'm ever thinking about Roth conversions or taking strategic distributions before the time I hit the age of my required minimum distributions. Short for RMDs is what those are. And that is going to come at 73 or 75, depending on how old you are. Okay. The Chase savings account, depending on this person's age, I would say $321,000 in a savings account is far too much. But again, depending on your timeline, your age, and things of that nature, I would say 12.5% in an individual account can be good. Like I said, this allows a lot of tax flexibility in retirement. And then ultimately, I think the Roth IRA, I would like to see that higher just because we don't want to have a staggering portion in traditional IRA that's going to create this kind of tax balloon in retirement. When we compare that to a Roth IRA, a lot of times it's good to have both of these because you are able to withdraw from that Roth IRA in retirement tax-free and it doesn't add to your income, like I was saying, whereas with the traditional IRA, it's going to do both. It's going to tax you and it's going to add to your income in retirement, potentially making things like Medicare more expensive and potentially making more of your Social Security taxable. So things you want to be considered. Now, I'm not going to talk about it too much, and this is, again, a fictional client, so the performance is made up, but it is important to understand how your portfolio is performing. I know this is something that a lot of people almost get stuck on too much, I would say, probably more so than they need to. But for performance sake, it's always helpful to understand what your year-to-date return is, simply how has it performed since January. You want to compare that to how similar portfolios are returning. Make sure you're invested in the right assets. And then you want to look at even quarter to date, which is just the last 3 months. You want to look at since inception, how long since you've started investing with your advisor, or how long since you've started putting money into Fidelity. What does that look like for you? And then finally, we'll move over into the gain and loss here. So I'll talk about it right here, and then we're going to dive a little bit further into what this actually means. So two key terms here I want you to understand is unrealized and realized, okay? So unrealized just simply means they're paper gains. They're not real because you haven't sold them yet. Remember, you can make $1 million in your portfolio, and until you sell it, it is not actually a gain, not in the eyes of the IRS, and not even in the eyes of whether you can spend that money or not. Because just as it had the potential to go up to $1 million, it has the potential to go to zero, right? That's just the reality when we invest. We never want it to go to zero, and we never want to even lose money. We have to remember Warren Buffett's number 1 and 2 rules of investing is never lose money, but we know it happens. So unrealized is just simply, hey, that's what my gains are, haven't sold them yet, and currently sitting at $211,000 for this example. Realized is how much have I sold, okay? I've taken these gains or I've taken these losses, and now the IRS is actually going to have consequential expectation from me, whether it's a loss or a gain, that I report this at the end of the year. So what this is saying right here is this portfolio has $570,000 of gains. 359 of that have been realized. So I'm going to have to report that for the year, and 211,000 is where I'm currently sitting. Now, when you speak with your advisor, it's very important that you know these numbers simply because this is going to allow you to plan for withdrawing these at some point. 2 other key terms here I want you to really understand are short-term and long-term. Okay, short-term is any asset, any stock, bond, mutual fund, ETF that you've held for 12 months or less. Long-term is the opposite, right? If you've held it for longer than 12 months, you're going to have long-term gains. Now, all I want you to know between these two is long-term gains are more favorable. In America right now, you are either taxed on these at 0, 15, or 20%. Most of you watching this video are going to be at 0 or 15%. And what that means, and I'll give you an example here in a minute, is it differs from short-term. Short-term is going to be taxed at your marginal tax rate, the highest tax rate that you're currently at. We're in a progressive tax system in America, as you know, which means that if you were to divvy up your income, let's say, again, you made $100,000, you know that every single portion of that income is going to be taxed at a different tax bracket. Now, when we talk about short-term gains, wherever you end up, wherever your next dollar is going to be taxed at, that is where the short-term gains are going to be taxed at. So just to compare it to long-term, let's say that I was going to be taxed at 15%, but I'm currently in the 22% tax bracket, you can see it's a lot more expensive to sell a position at a short-term gain. And before I dive a little bit further into that, let's show one more important thing here I want you to understand when you're looking at your portfolio is your income, okay? Because depending on where you are in your life, depending on where you are in retirement, you can get a lot of income that meets your needs from your investments. You can get income by investing in bonds. You can get income from investing in stocks. There's different strategies and ways to get income out of your portfolio. But generally, anytime you see a statement, it's going to tell you how much income you're making. So for this instance, we see that we're making about $16,000 on an annual basis from our accounts. You'll see that it comes about $10,500, $10,600 from an IRA, which means it's not going to be taxed and it's not going to be added to my income for the year. Same with a Roth IRA. But I want to point out this trust account here because that $1,561 is taxed in the present year. Remember, if we do not have a retirement account, any dividend, any interest, any payment that is kicked off in a non-retirement account is added to my income in the year that it occurs. Now, I know you might be thinking, hey, you just told me a moment ago that I'm only taxed on the profit that comes from an account like this. Well, that doesn't factor in dividends and interest because really this is just money that these companies are paying you for holding those stocks. So it's not you're selling these positions, you're just getting a dividend or an interest from a bond or stock. So that's something important to know. If you have heavy dividend or interest paying investments, you want to consider having them in a retirement account to the point that it suits you. Okay, so now let's finalize here just by digging a little bit deeper into the gains and losses part that I was mentioning a moment ago. I know there's a lot of numbers here and I promise I won't get too in depth, but these are my different accounts. These are my current ending values. All a gain represents to you is the difference between this number right here and this number right here, okay? All a cost basis means is how much did I pay for the investments currently in the account. Let's take this traditional IRA for an example. This means that I've put over $1 million of cash into my traditional IRA. And since that time, in addition to, regardless of when I put the money in, it's up to $1.2 million. Now, I sure hope that this is a new account because that would be very poor to only have that much amount of gains. But then you can see that difference, like I said, come out in all short-term gains, right? So I answered my own question there. Essentially what we have is someone recently put in $1 million and they've gained $112,500 in less than 12 months because remember, a short-term gain is any time that we have an account for or an investment for 12 months or less. And if I were to compare that with my trust account, you'll see that I have unrealized both short-term and long-term gains here, right? So within my non-retirement, I have assets that have made both gains that I've owned for 12 months or less and assets that I've owned for 12 months or more that have currently sitting at this level of gains. Remember, unrealized does not mean that I pay taxes on these present day. It's only when I realize them that I have to pay taxes. So let's see where those realized gains are coming from. And again, this is a demo account, so some of these might not make sense if you're actually looking at the numbers, but you'll see that I've realized all of these positions here. So if I realize a position, remember, in a retirement account, like a traditional IRA, like a Roth IRA, or like this traditional IRA, none of this matters, okay? The IRS does not care when we realize gains or losses in a retirement account until we actually withdraw them. And that is when we would owe the IRS money. Trust account is a little different, and you can see that we have realized long-term gains of $36, and we have a realized short-term loss of negative $8. So this is a good time to draw this out, and then I'll let you go. We are able to take this loss, and we're able to subtract the gain, and we only have to pay taxes on the difference between the two. Now, I know 36 and 8 aren't staggering numbers, but essentially what we're saying here is that you would only have to pay taxes on $28 here. And that's something very important to understand because in this instance, you'd be able to, if you are finishing with long-term capital gains rates, you'd only have to pay 15% on that $28. And again, small numbers, but I hope it can make it a little simple for you. And I know we're about 15 minutes here. Normally I talk too long, but folks, I know I've thrown a lot at you today, so I will close here. Listen, if you have any questions, please feel free to reach out to me. Would be happy to help any way I can. But thank you as always for your support, and we'll see you next time.